Imagine two countries with huge land, deep reserves of oil, gas, minerals, and enough space to stretch past the horizon. One of them collects so much revenue from its natural resources that its citizens pay no income tax and live with heavy state support. The other has larger pools of natural wealth on paper, stronger institutions, and a far more diverse economy. Yet, its residents deal with rising bills and some of the priciest housing on the planet. According to the IMF, in 2023, oil made up close to 62% of Saudi government revenue. In Canada, every natural resource combined fed roughly 19.2% into the nominal GDP. That single gap explains a large part of the lived reality in each place. Two nations, very similar landmasses, but two different outcomes. The contrast leaves a simple question hanging in the air. How did the richer land start to feel poorer? Let's zoom out and look at Canada and Saudi Arabia side by side in size, population, GDP, and resource makeup. Canada covers nearly 9.98 million square kilometers, which makes it the second largest country in the world in terms of size. Meanwhile, Saudi Arabia spans about 2.15 million square kilometers. Despite that big difference in land area, their populations are somewhat close. Canada has over 41 million people according to World Bank data. Saudi Arabia's population is under that, roughly over 35 million. In economic terms, Canada's GDP sits at around $2.24 trillion in 2024, while Saudi Arabia is lower at about $1.24 trillion. On a per-person basis, Canadians average roughly $54,300, compared to Saudi's $35,100, as per the World Bank's data. When it comes to natural resources, both countries are rich, but in different ways. In Canada, the mineral sector is huge. In 2024, mineral exports reached $153.3 billion, which was about 21% of its merchandise exports. Canada produces copper, nickel, cobalt, lithium, rare earths, and more. Saudi Arabia leans heavily on hydrocarbons. Oil dominates its exports, and that shapes how its economy works, both in revenue and in state planning. In fact, it's the largest oil exporter in the world. The kingdom turned fossil fuels into state power. Oil and gas drive most of the government's budget. With oil accounting for roughly 62% of Saudi government revenue, a single commodity shapes public spending decisions. This lets the country run with no personal income tax, while still offering free public education and near-universal healthcare. Gastad placed basic healthcare coverage at roughly 100% in 2024. Housing support is a major policy pillar. Programs like Sakani moved large numbers of families into homes through subsidized finance. The Public Investment Fund adds another source of strength. The $925 billion fund fuels megaprojects and stabilizes the budget in weak oil years. Then comes Vision 2030. Tourism, entertainment, NEOM, and tech zones form the plan to shift the economy away from raw hydrocarbons, though oil still pays for the transition. Canada sits on a huge stock of natural wealth, which includes forest, fresh water, oil and gas, and large mineral deposits. The extraction side is active. In 2024, mineral and metal exports ran above $150 billion, and resource export volumes have consistently increased since 2020. The problem is not the absence of resources, it is how much value leaves the country without being captured. Resource rents, which are the share of GDP that comes from selling natural assets, are modest for Canada compared with resource-heavy states. The World Bank shows Canada's natural resource rents around low single digits of 4.9% of GDP in recent years. Privately owned concessions and global commodity markets mean profits often go to firms and investors rather than to public coffers. Provincial royalties and corporate taxes raise some revenue, but complex royalty regimes and long permitting cycles slow new projects. The IMF and OECD note regulatory delays and supply bottlenecks that add costs and push downstream processing overseas. Those policies and structural issues impact citizens. Housing costs reach record levels in 2024. Around 45% of Canadians reported strong concern about affordability. Infrastructure around growing cities strains under rising demand. Industrial processing of raw materials is also limited, as Canada exports ores and energy that other countries then refine into higher value products. The result? Canada ships inputs and imports higher value goods, keeping a slice of the economic pie small. Here's the core contrast. Canada runs one of the highest tax burdens as a share of its economy, nearly 14.2% of GDP, but it collects very little from its natural asset base. Resource rents hover around 4.9% of GDP. That means most of Canada's tax revenue comes from labor and capital, not from its natural wealth rent. In contrast, Saudi Arabia has a relatively low tax revenue of around 7.8% of GDP, but natural resource rents make up a massive portion. Roughly 25% to 26% of GDP goes to resource rents, mostly oil. That lets the state spend heavily on public goods without imposing a broad personal income tax. Its government consumption, or spending on public benefits, is about 21% of GDP. Since the state captures so much of the oil rent, it can export energy with huge margins and reinvest it in sovereign wealth funds or mega projects. So, why do these differences actually exist? Saudi Arabia operates under a highly centralized structure. Decisions move fast, projects get approved quickly, and the government can tightly control how energy revenue is monetized. That creates efficiency, but it also limits democratic participation. Canada works differently. Provinces hold significant power, which means overlapping regulations and slower timelines. Environmental reviews and provincial interests often delay or block projects. So the difference is structural. Saudi Arabia's centralization drives speed and profitability, while Canada's decentralized model creates more accountability but slows outcomes. The long-term risk for each nation can be distilled into a single choice. For Saudi Arabia, the risk is the resource curse, where one commodity wealth strangles all other economic development. The leadership knows this. That's why Vision 2030 is aggressively pouring oil profits into creating new, non-oil industries such as tech and tourism. Canada already has diversity. Its risk isn't total collapse from a single market, but the constant internal friction over how to manage a massive decentralized resource sector with conflicting interests. One model risks a sudden geopolitical shock, while the other risks a painful grind of political division and environmental reckoning. Both are wrestling with the same core dilemma: how to make resource wealth a blessing rather than a trap.